If you want to make passive monthly income in the stock market, then selling covered calls might be the answer you're looking for. I have been selling covered calls for years now and make steady monthly profit on my portfolio. And in today's video, I am going to teach you this investing strategy step by step. Ladies and gentlemen, welcome back to Pandrea Finance. My name is Alex Pandrea, and in today's video, we are going over exactly how to sell covered calls and generate monthly income. Covered calls are used by the largest hedge funds and institutions, and by the time you finish watching this video, you'll have all the tools necessary to make these trades yourself and, well, make money. Now, there's two things that you need to do. First is to watch this video all the way through because you don't want to miss any important details. This concept is both easy and rather complex, so don't worry, we'll make everything as easy to understand as possible. Second, you need to hit that like button. Just a little tap on that little thumb never hurt anybody. So if you're ready, then so am I. Let's get into the video. Okay, let's break down covered calls in its most simplistic form. When you own 100 shares of any company, you can sell covered calls on your position and collect a payment called a premium simply for selling that option. This premium is paid to you by the person on the other side of the trade who is buying that option. Now, it's called a covered call because your position is covered by the 100 shares that you own. You are putting up your shares as collateral for this trade. If the trade goes against you and you're forced to sell your shares, then you are covered. So let's go through a scenario. Let's pretend we have 100 shares of a given stock and you decide you want to sell a covered call on your position. Here is what's going to happen step by step. First, you must have a collateral of 100 shares for each one option contract that you sell. You pick a strike price and an expiration date for the option that you want to sell. The strike price that you choose must be higher than the current price of the stock. This is called selling out of the money calls. You sell that option to the option buyer and then you get paid a premium. That payment gets deposited into your trading account as cash right away. You have now entered into a contract with the option buyer. Now, for you to win this trade, you do not want the stock price of the company to reach the strike price of your option by the expiration date. That is the ultimate goal. If your strike price is not reached by the time expiration, you win the trade and you will get to keep the entire premium. So it's pretty simple. All you have to do is choose a strike price that you do not think that the stock will get to. See, when buying a call, you have to make a prediction on what price that stock will reach, which is much harder to do, I think. For selling calls, we have to say to ourselves, you know what? I don't think that this stock will reach this price by this date. And then we make a trade based off of that. So if I own 100 shares of company X, let's say I bought the company a while ago and I'm already in the profit, and I want to start making some consistent returns on holding that stock. Company X is trading at $50 right now. I decide I'm going to sell covered calls on my position. So the first thing that I have to do is choose a strike price that I do not think the stock will reach by a certain date. Let's say by next month, I don't think company X will reach $55, which would be a 10% increase for the stock. I pick to sell an option with a strike price of $55 and an expiration date of 1 month out. Once I sell this option, a few things will happen. First, the brokerage will put aside 100 shares that I own as collateral for this trade. These are still my shares, but I just can't do anything with them before I exit out of my options trade. Second, I will be paid a premium for selling this option paid to me by the option buyer. Now, this premium is put into my account right away. In this case, let's say the premium is $2. I will get paid $200 because remember, one option contract controls 100 shares, so we multiply the premium by 100 for each contract. So boom, there you go. I sell the option and get paid $200 that goes straight into my trading account. Now the trade is on and there will be a winner and a loser of the trade. And trust me, by selling options, you will win more than you will lose. Because, well, if you buy options, you usually lose. So that could only mean that if you sell options, you usually win. Now, at this point, one of three things can happen with the trade. Scenario number one, the stock price does not reach the strike price by expiration. That's good. Scenario number two, the strike price reaches and exceeds the strike price by expiration. Not so good. And scenario number three, you decide to close your position early before expiration by buying back the contract and closing the trade. Now, in scenario number one, the stock price does not reach the strike price. that means the trade worked out in our favor and the option will expire out of the money. When an option expires out of the money, or in this case not hitting the strike price, then that option will have no value left. It will expire worthless. This is exactly what we want. As the trade goes on, we want the option contract to lose more and more of its value until it's worth $0.00. This will ultimately mean we get to keep the entire premium that we sold in the beginning. In scenario number 2, the stock trades up and actually ends up passing the strike price. Well, in this case, you lose the trade. So what does this mean? Well, according to the terms of the contract that you entered when you took on this trade, you agreed to sell your shares at the strike price. So the buyer of the contract will most likely take you up on that, and your shares will be called away from you, basically taken away. Oh no, my shares. Meaning you are forced to sell your shares at the strike price. So what do you lose? Well, for one, you lose your shares, which can suck, but also you lose the potential of profit that you could have made if you didn't sell your shares. So if you sold a call, for example, with a strike price of $55 and at expiration, the stock is now at $65, well, now you just lost the chance to make the extra 10% profit per share. Now, scenario number 3 is the one where everyone gets a little bit confused. Closing your position. Now, closing your position when buying a stock is easy. We sell it. Done. Right? When buying options, it's pretty straightforward as well. We buy an option, and to close the position and get out of it, we sell it. Boom, done. When selling options, to close the position, you have to buy it back. Now, let me say that again. If you sell options, you need to buy back the option in order for us to close our trade. Now, if we want to wait until expiration and the stock does not hit the strike price, like in scenario number 1, the option will expire worthless and we don't need to buy back anything because there's nothing to buy back. It's worth 0. But sometimes we don't want to wait all the way until expiration. That's okay. We can close out our trade anytime that we want. The goal of this is to sell high and buy low, keeping the profit in between. Ideally, sell very high, right? Get a nice big premium, and then have that option decrease in value so much that it's worth almost nothing, pennies. And then even though you didn't wait until expiration, you still get to keep the majority of the premium that you collected. This is why it's very important to keep that premium that you receive for selling that option in your trading account until expiration to see how the trade goes. You might need some of that money to buy back the contract if you want to close out the trade early. I, for one, don't wait until expiration for the majority of the calls that I sell. When the option price decreases in value by 50%, I might start buying back the option, closing the position. This means that I will only keep 50% of the premium that I initially got, but I'll be able to close that trade and put on a new one. So for example, if the option decreases by 75%, that means that when I buy it back, I will keep 75% of the entire premium and use 25%, the leftover, to buy the option back and close out the trade. All right, let's take a look at a live example and put it all together. For this example, we're taking a look at Virgin Galactic. Now, I went ahead and bought 200 shares of Virgin. Now, because I own more than 100 shares, I can then go ahead and sell covered calls on my position and generate some income. So as you can see here, Virgin Galactic is trading at $19.38, and it had a nice little spike during the trading day. So I think this is a good entry point to sell some covered calls. We're gonna go ahead, trade options, and pick an expiration date. Now, typically for me, I like to go 1 month out when selling options to get a really good premium, and hopefully that premium loses value throughout the trade, and I could even close it early and move on to the next one, as opposed to weekly options. Again, this is just my opinion of what I like to do, but the research does favor selling monthly options as opposed to weekly options. So again, normally what I would do is go to about December 17th, pick that option and pick a strike price that's about 75% chance of profit. In this case, it'll be the $21 calls, so I would click on that option. And because I have 200 shares, I can sell 2 contracts on top of that. So I hit 2, and you can see that the minimum credit, my premium that I'm going to receive, is $206. So I would go place that trade and collect the money. But for this example, and because I'm doing it here for filming, to show you the movements of the option prices, we're gonna go and sell a weekly option contract, again, for this example. So we're gonna come back on the expiration date and we're gonna choose November 19th, which is going to expire next week. And again, I like to go about 75 to 80% chance of profit. So in this case, let's choose the $20 calls, and we're gonna go ahead and sell 2 covered calls on our position. So we're gonna hit 2. Now for the price here, I'm just gonna go ahead and enter in whatever the bid price is so we can get filled right away, which is 40 cents. And you can see the minimum credit here, the premium that we're receiving, is $80. Now by hitting review, you'll see that the collateral pops up as the 200 shares of your Virgin Galactic stock. So it's all laid out there. You have 2 option contracts that you're selling. You're getting 40 cents per contract, which would be $40 for every 100 shares. We have 200 shares, so we are getting 40 times 2 is 80. They do the math for you. It's amazing. The collateral is 200 shares, and we are going to swipe up to make the trade. And there you go. You get the order confirmation, 2 of 2 contracts sold, and you get a total of $80. Thank you. Thank you, Robinhood. And that $80 is now in your trading account. And now we can move on to the next step. Okay, it's Monday morning now and the stock market is open and Virgin Galactic is trading down a bit. So that ultimately means the option that we sold on Friday hopefully will have lost value. So let's go ahead and take a look. We go scroll down to our option position. You can see here the number of contracts 2 that we sold and the value is negative 52. Now, why is the value shown as a negative number? Well, it was pretty complicated to understand that first, but it's pretty easy, trust me. The negative value means that right now, if I were to close the position, I have to pay $52 of my own money to close the contract, to buy it back. But remember, we already received $80 when we sold the contract. So this is showing what is left on your premium for the contract. We took in $80. If we want to get rid of this contract right now, we have to pay $52, which leaves the difference in profit. And you see the difference here as $28 or 35%. Again, our goal is for that negative value to reach 0 or close to 0 as much as possible. So the lower the number that you see there in the negative value, the better it is. Sell high, got $80, buy back at a low price. So let's make pretend that time goes by on this trade, and now you see a value of negative $10. Well, what does that mean? Well, that means that there's only $10 left in that premium. We collected $80. If we were to buy it back, we have to spend $10, keeping $70 as profit, and then you would see total return $70. So I hope that makes sense. So let's say you're happy with this profit and you want to close out the position. Well, how do we do that? Well, we have to buy back the contract. We sold it to open, right? And then we have to do the exact opposite to close it. We're going to go click on the option that you see here, Virgin $20 call. It's 27 cents now. We're going to go down, see again all the details of this contract. We're going to hit trade and we're going to hit buy. And we're going to hit buy, and then the order form will come up just as if you were buying or selling contracts to start with. So we're going to go ahead and hit 2 because we have 2 option contracts that we sold that we're going to buy now. I'm going to go ahead and enter 27 cents for the ask price just so we can get filled right away. And you'll see our max cost, what we have to pay is $54. But remember, we already took in the $80. So the difference that we're going to keep is profit. We're going to hit review, and now you can see release collateral pops up, which is the 200 shares that I put up as collateral for this trade. It's going to be released back to me. We're going to go ahead and swipe up, order received, and this closes out the position. So now we can hit done, and you can see everything disappears on your position, so you don't have the position anymore, and you can go about your day. You have your collateral back, so now you can open up a new trade and collect that premium again each week, each month, and if you ask me, pretty easy way to make some easy money. Now, whenever learning something like this, it's only normal to have questions. Look, when I started learning about options, I could watch whole videos and at the end of it still have a million questions. Now, I do my best to answer your questions down in the comments, so if you ever have questions, you know where to leave them. But what I want to do here as a little bonus for this video is to try to answer some of your questions you may have even before you ask them. Fancy. Can you lose money selling covered calls? So here's the honest answer. If you own stock and already are in the profit on your stock position, then you cannot lose money selling covered calls and waiting until expiration. The worst thing that is going to happen is you'll lose your shares. Well, not lose them, but be forced to sell them at the strike price. And you might feel like you're losing money if your stock shoots up way past the strike price and you're forced to sell at a lower price, but you only lost the chance to make that extra profit. Remember, you should always sell your calls at a strike price that is above where you bought the stock initially, because then you'll always be in the profit. So whether or not your shares get called away, you will still make money. And I mean, profit is profit, right? So do you get to keep the premium if the shares get called away? Yes. The answer is simply yes. Your premium gets deposited into your trading account right away and is yours to keep because you did not have to buy back the option right at the end. Can you sell options without collateral? I would say the answer to this is no. Do not ever try to sell options without having the collateral. Now, Robinhood doesn't allow you to sell options without collateral in the first place, because that is, of course, very, very dangerous. So if you use another brokerage that may allow it, just make sure that you have collateral in the form of shares or cash before selling options, because you do not want to be forced to buy 100 shares of a certain stock and then go into margin and then debt and then your whole account is blown up for what? So stay away from that. That is my advice. What happens with my collateral? So when you put up collateral, you can't do anything with the shares until the option position is closed. The shares will be released back to you the day after the option expires, or right away if you close your position early. Once you have your collateral back, you can go ahead and sell another call using the same collateral and repeating the process. Will I have to pay taxes on the premium that I collect? Yes, another simple answer. Just like any other trade, when you make profit, you will be subject to the almighty short-term capital gains tax that we all know and love. So you'll definitely want to keep an eye out and make a plan for that. What's the best strike price and expiration date to pick? Well, this is all going to be relative to the stock that you are trading and factors like implied volatility and the Greeks. Now, this video here will explain the statistics behind option selling in more depth. Now, if you watch only one video on my channel, that's the one that I recommend you to watch. It gives you my full strategy of picking strike prices and things like that. I've also left links down in the description below of other videos that I recommend that you watch to further your journey into this world of options. Now, here is a bonus tip. If you ever want to sell your long stock position, don't just sell it. Sell covered calls at a strike price that you are okay selling your shares at. So because you want to sell anyway, you are now hoping that the stock price reaches the strike price and that your shares get called away. So basically, you're going to receive an extra premium just for selling your shares. Free money. I'll take it. My friends, if you found something useful in this video, go ahead, hit that like button and share this video around with your friends. I'm sure you have friends who might be interested in investing, and come to think about it, so many people have stocks and portfolios and are not taking full advantage of it. So together, I think we can make the world a better place by, I don't know, selling options. Thanks so much guys for watching. You can check out my other videos here and here, and we will see you on the next one.